Have you ever wondered what industry leaders or policymakers really mean when they say something? Their words often carry hidden layers of context and implications, revealing much more than meets the eye. That's exactly what we want to do here on Who Said What. I'm Krishna, and in this series, I'll pick fascinating comments from notable figures, break them down, and explore the broader stories behind it. Since a bunch of you were okay with the pilot episode, my boss allowed me to carry on with this show. Now, today, I have 6 interesting comments for you. The first one, Praveer Sinha, the CEO of Tata Power, recently said we're looking at a profit after tax of over 10,000 crores by 2030 from a profit of 4,200 crore last year. That's more than double their profits right now. So this got me curious about why would he make such a comment? What will they do to make so much money in such a short period of time? And the biggest of all, is this even possible? So I dug a little deeper to find out the answers. Let me start by giving you some context as to what Tata Power does. You see, Tata Power is India's largest vertically integrated power company which operates across the entire electricity value chain, from generating and transmitting electricity to distributing it to homes and businesses, and even trading power. Tata Power is involved in nearly every stage of delivering electricity to the end user. But the big driver of their future growth lies in a shift towards renewable energy. Currently, Tata Power generates 6.7 gigawatts of renewable energy, and by 2030, they want to push this figure up to 23 gigawatts. The shift isn't just about going green, it's also a smart business move. You see, once renewable energy projects are built, they're cheaper to operate because you don't have to keep buying fuel as you do it with coal plants. And with global and national policies emphasizing the reduction of carbon emissions, renewables are becoming more than just an eco-friendly option. They are quickly becoming the economically viable one. To achieve this massive renewable energy expansion, Tata Power is investing heavily in building new solar and wind farms. But generating renewable energy is only part of an equation. Many of these projects are located in remote areas, far from cities and industries where electricity is needed most. This is why Tata Power is also upgrading its transmission and distribution networks. Currently, they operate 4,600 kilometers of transmission lines which transport electricity from power plants to regional hubs. They plan to increase this to 10,500 kilometers by 2030, ensuring that electricity from their new renewable projects can reliably reach cities and towns. Distribution, which involves delivering electricity from these hubs to individual homes, businesses, and factories, is also getting a major boost. Tata Power plans to triple its customer base from 12.5 million to 40 million by expanding operations to states like Rajasthan and Uttar Pradesh. Every additional customer means more steady long-term revenue from electricity bills. This growth does come at a cost. Tata Power is planning to invest 1.46 lakh crores by 2030 to achieve these ambitious targets. Most of this 87,600 crore will go toward renewable energy projects, while 29,200 crore will be spent on upgrading transmission lines. The rest will support improvements to distribution networks and technologies like pumped storage, which acts as a giant battery to store and release electricity when needed. Funding for these projects will come from loans, equity, and the sale of non-core assets such as some overseas coal and hydro plants. This aggressive push towards renewables isn't happening in isolation. It's part of a larger global trend driven by government policies and market incentives. At COP29, global leaders debated measures to phase out fossil fuels and set ambitious renewable energy targets. India is committed to achieving 500 gigawatts of renewable energy capacity by 2030, and it seems like Tata Power wants to position itself as a key player in this transition. There's also a financial incentive. Renewable energy projects often operate under long-term power purchase agreements, which lock in stable revenue streams for 20 to 25 years. For example, Tata Power can supply electricity to governments or large industries at a fixed rate, ensuring predictable income over the life of the project. This stability is particularly attractive compared to coal plants where profits can swing wildly with fluctuating fuel prices. And as I mentioned earlier, solar and wind farms don't require constant fuel purchases, making them far cheaper to run in the long term. especially as coal and gas prices continue to rise unpredictably. Of course, Tata Power isn't alone in pursuing renewables. Competitors like Adani Green Energy, NTPC, and Reliance Industries are also making aggressive moves. Adani Green Energy, for example, is targeting 45 gigawatt of renewable capacity by 2030. The Adani Group has committed $100 billion to renewable sectors and is developing a 50 gigawatt energy park in Gujarat by 2030. NTPC, India's largest power producer, has set a target to install 60 gigawatts of renewable energy capacity by 2032, aiming for 50% of its total capacity to be non-fossil based. The company is also exploring innovative solutions like green hydrogen, waste to energy projects, battery storage, and even nuclear energy to diversify its portfolio. Meanwhile, Reliance is planning to establish 100 gigawatts of renewable energy installations by 2030 with a heavy focus on solar. Reliance is building an entire solar manufacturing ecosystem from polysilicon and wafers to solar cell and modules, which not only supports its own projects but could also dominate the supply chain for others in the sector. More recently, Reliance spent over half of its committed 75,000 crores in new energy business. In between all of this intense competition, Tata Power's edge lies in its integrated model. The company is not just generating power but also building the infrastructure needed to deliver it and manufacturing the solar panel it uses. Tata Power's goal to more than double its profit by 2030 is deeply tied to not just India's broader energy transition but globally as well. Moving on to the sector that I am extremely fascinated by, quick commerce. Dabur's chairman Mohit Burman recently said in an interview with ET, we have witnessed a marked shift in consumer buying patterns in favor of emerging channels like quick commerce. While this has resulted in emerging channels growing at a higher pace, it has also put general trade under stress. In plain terms, he's saying people are flocking to quick commerce apps like Blinkit and Zepto, and that's putting pressure on Kirana stores. Let me quickly set the scene here. 10 years ago, online quick commerce was pretty much non-existent. It only really took off during COVID, and since then these platforms have gone from being last-minute saviors to practically online malls. They are so fast that Amazon's one-day delivery feels like an eternity now. Quick commerce has completely changed how we shop, whether it's our ghar ka ration or the latest iPhone. But are these platforms killing Kirana stores? That question has been stuck in my mind for a while, and honestly, people have some pretty interesting takes on this. One report claims that 59% of kiranas have been impacted by quick commerce. But then there's Adit Palicha, CEO of Zepto, who says this idea that quick commerce is hurting kirana stores is just plain wrong. Here's his argument. Between FY23 and FY24, India's grocery and household essential consumption grew by $46 billion. Out of that, quick commerce accounted for less than $5 billion. The remaining $41 billion that went to Kirana stores. Adit says this proves that the narrative about quick commerce shrinking and Kiranas doesn't hold up against the data. In fact, he argues that Kiranas are actually growing alongside quick commerce thanks to the overall consumption growth in India. But honestly, I'm not sure what the real answer is because we don't have enough data to go on. Most of the retail market, especially Kirana stores, is unorganized, which makes it hard to measure. Quick commerce is clearly a game changer. And yes, it might have cut down on those small grocery runs we all used to make, but the thing is, quick commerce is only available in a handful of cities. So saying it's affecting all Kirana stores, that feels like a stretch. On the flip side, you could argue that most high value purchases happen in top tier cities, so maybe there's some truth there. But again, we just don't have enough solid data to confirm it. Considering the insane amount of money pumped into quick commerce platforms over the last couple of years, especially recently, it's clear something big is happening here. It might be affecting Kiranas a bit now, but not on a massive scale. As for the future, who knows? It'll be interesting to see how this plays out. Since we are talking about quick commerce, there's one more comment that was recently made by Dinshaw Irani, CEO of Helios Capital, in an interview with ET. He said the compression in margins for most of these established brick and mortar players in the consumer space has been because of the consumer tech companies. Quick commerce, food delivery, all these spaces are going to look very exciting. In fact, quick commerce is something which is really homegrown. Globally, there is not many proponents of this kind of a business. So it has done phenomenally well in India. These quick commerce platforms cater to the growing demand for convenience, allowing people to buy what they need without planning ahead or stepping out of their homes. This shift has come at a cost for traditional retailers whose models rely on consumers visiting physical stores to buy in bulk and benefiting from value pricing. Quick commerce, with its speed and hyperlocal focus, has squeezed the margins and footfalls of these established players. Deepak Shanoy, founder of Capital Mind, had some time back tweeted about the broader landscape of online or internet companies. I am paraphrasing, but he said something like how the internet companies has made competition high and it's easier to beat large incumbents. Now, the most obvious name that comes to my mind is DMart. DMart, the undisputed king of offline grocery retail in India, is now feeling the impact of platforms like Blinkit. During DMart's first quarterly earnings call this year, Neville Narona, CEO of DMart, acknowledged the rising influence of quick commerce. He had also said, "We don't intend to do any quick commerce. Our model is pretty robust." But will I say there's no impact? Maybe a 1%, 1.25% same store sales growth impact in some metro locations. And in their second quarter's press release, DMart doubled down on this acknowledgement, stating that we clearly see impact of online grocery formats including DMart Ready in large metro DMart stores which operate at a very high turnover per square feet of revenue. This seems pretty interesting to me. Do you think quick commerce is eating into kiranas? Let me know in the comments below. The next topic is about dollar. India's External Affairs Minister Dr. S. Jaishankar recently said we have no interest in weakening the dollar. It probably flew over a lot of people's heads. Why would someone even bring up the idea of weakening the dollar? And what does it mean for India or for anyone else? Let's break it down. First, let's understand why dollar is such a big deal. The US dollar isn't just America's currency, it's the world's default currency. This means most international trade, whether countries are buying oil, wheat, or iPhones, is done in dollars. In fact, approximately 88% of global forex transactions, about 60% of central bank reserves, and over 50% of global trade are invoiced in dollars. Banks in different countries hold dollars in their reserves to settle trades, and most central banks also stock up on dollars to stabilize their own currencies. When Jaishankar says India has no interest in weakening the dollar, he is essentially saying that we benefit from the dollar, staying stable and strong. Let's flip the situation to understand why someone would want to weaken the dollar. Countries like Russia and China, for example, have long criticized the dollar's dominance. Why? Because they feel it gives the US too much power. Since the global financial system runs on dollars, the US can impose sanctions that cut countries off from trading, as it has done with Russia when $300 billion of its central bank reserves were frozen by Europe and US. A weaker dollar or an alternative currency would reduce America's financial leverage. But India doesn't face those kind of problems. On the contrary, a stable dollar helps India's trade and economy. This is why Jaishankar is quick to clarify that India has no plans to weaken the dollar or challenge its role. His comment is a part of a bigger conversation happening in global politics about de-dollarization. This term refers to reducing reliance on the US dollar for international trade and financial transactions. Some countries, particularly in the BRICS, have floated the idea of creating an alternative currency for trade between member nations. For instance, Russia wants alternatives because US sanctions block its access to dollar transactions. China is promoting its own currency, the yuan, for global trade, though with limited success. In the BRICS context, some people might assume India is also on board with these efforts to reduce the dollar's dominance. Jaishankar's statement sets the record straight. India isn't interested in destabilizing the dollar. There might be several reasons. India does a lot of business with the US. It's India's largest trading partner with bilateral trade worth over $128 billion. Most of this trade is settled in dollars. A weaker or unstable dollar would disrupt this system, making trade more expensive and chaotic. Second, India imports over 85% of its oil, and almost all these payments are made in dollars. If the dollar's value becomes unstable, oil prices could skyrocket, causing inflation at home. In a country where energy prices directly impact everything from transportation to food, this would be disastrous. India receives over $100 billion annually from Indians working abroad, many of whom send money in dollars. A weaker dollar would mean less value for these remittances, directly hurting millions of families. Indian companies and banks also borrow money internationally in dollars. If the dollar's value fluctuates widely, it again creates uncertainty in repayments and financial planning. That was it about dollar. In the next one, I'll talk about the bonds market, specifically the Indian bond market. India's corporate bond market is surprisingly small for an economy of its size. This week, SBI chairman CS Shetty highlighted the issue, pointing out that while India is one of Asia's largest economies, companies still struggle to raise long-term funds through bonds. Now let's break this down. First, why is there even a need for corporate bond market? Banks like SBI primarily rely on short-term deposits from customers. This means they can't easily lend money for long-term needs like loans that span 10 to 20 years. For infrastructure projects or large-scale business expansions, companies need long-term funding, and issuing bonds is one of the ways to get it. But despite the need, India's corporate bond market isn't growing as fast as it should. Even though SBI issued 50,000 crores in bonds this year, the overall market remains underdeveloped. One of the key issues is a bias towards higher rated bonds. Bonds are rated by agencies based on companies' creditworthiness. Think of it like a report card. AAA is the highest rating, meaning that the company is extremely unlikely to default, while AA is also considered very safe. The problem, around 95% of all bonds issued in India come from these AAA and AA rated companies. In FY22, a whopping 80% of bonds were AAA rated and 15% were AA rated. This leaves out many companies that might not have the top-notch ratings but are still reliable borrowers. These companies struggle to raise funds because investors shy away from the perceived risk. Next, there's how bonds are sold. Almost 98% of all corporate bonds in India are sold through private placements. This means they are offered directly to select group of investors instead of being open to the public. While this method is quicker, it lacks transparency and makes it hard to determine fair market pricing. Compare this to global markets, where public bond issuances are more common, allowing for better price discovery and broader participation. Another hurdle is the limited pool of investors. In India, corporate bonds are mostly bought by banks and insurance companies and mutual funds. Retail investors, which is regular people like you and me, barely participate. This is in stark contrast to countries like the US, where individual investors actively buy corporate bonds, making the market more dynamic. Now let's talk about risk management tools. One major gap in India's market is the lack of credit derivatives like credit default swaps. A CDS works like insurance for bonds. If a company defaults on its bonds payment, the CDS compensates the investors. Without tools like this, investors hesitate to buy bonds from companies with lower ratings, further shrinking the market. Despite these challenges, there are some positive signs. For instance, the total outstanding corporate bonds have grown to 50 lakh crore rupees by FY24. Platforms like electronic bidding platform have streamlined the process for private placements, and the request for quote system is improving transparency in bond trading. New products like tri-party repo agreements, which allow short-term borrowing using bonds as collateral, are also gaining traction. But the progress isn't enough. Secondary market trading, the buying and selling of bonds after they are issued, remains weak. Most bonds in India are held to maturity, meaning investors don't trade them. This lack of activity stifles market growth. Even the average daily trading volume is at around 5,700 crore rupees in FY24, and it is tiny compared to the size of the market. Regulators are trying to address these issues. For example, they have allowed banks to hold corporate bonds under a category called held to maturity, which reduces the risk of market fluctuations. They've also lowered the face value of bonds to make them more accessible to smaller investors. But as Shetty points out, the market needs a broader mix of investors and more activity beyond just AAA rated bonds. Why does this matter so much? India has ambitious goals like becoming a $30 trillion economy by 2047. To fund the massive infrastructure projects required for this growth, India needs a strong bond market. While trading platforms and processes have improved, the real challenge is creating a vibrant secondary market where bonds are actively traded, attracting a diverse range of investors. India's corporate bond market is marking a progress, but there's still a long way to go before it can fully support the country's economic aspirations. I think the next one is something a bunch of us would be interested in. It's about salary growth. India's chief economic advisor recently highlighted a key concern regarding employee compensation in the private sector. He said the staff cost of private listed companies, whether it is information technology firms or general, has been coming down. In other words, compensation growth has become weaker and weaker. He further said that while companies have seen record profits, they need to also prioritize employees and investments. He further added, now it is a time to engage in good combination of capital formation and employment growth as well. In simple terms, he pointed out that despite thriving financially, companies are not paying their workers enough, which could hurt both employees and the economy in the long run. He suggested a more balanced approach where businesses focus on growth and job creation. In response to these concerns, Ramani, CFO of TeamLease, a leading job portal, offered a contrasting opinion during a CNBC TV18 interview. She pushed back against the idea that wages were stagnating across the board, saying,
No, I kind of disagree with that statement, simply going with the numbers that we deal with, because for us, the salary inflation for the 3 lakh employees that we have on our rolls has been consistently between 6 to 8% year on year. Only for IT over the last 1.5 years, it has been slowed down. It's like 2 to 3%. And that's more like a correction which has happened, like the hikes that were given during the 2 years of COVID time.
According to Ramani, the slowdown in IT sector salaries is an adjustment after a period of unusually high raises during the pandemic. Beyond IT, she emphasized wage growth in most sectors has remained steady. Her broader point was that formal job creation continues to grow, with jobs increasingly moving from the informal to the formal sector. This shift, she explained, ensures employees gain access to benefits like Provident Fund contributions. Adding to the discussion, Dhananjay Sinha, head of research at Systemics Group, in a LinkedIn post explained that while corporate profits are at record highs, the connection between employee pay and company sales has changed over time. According to Sinha, contrary to common understanding, compensation growth lags sales, rising slower in an up cycle and falling less during the down cycle. In simple terms, this means that during good times, employee wages grow more slowly than the company sales, and during tough times, wages don't fall as much as sales do. He pointed to factors like automation and digitization, which are reducing the need for workers in some areas. Sinha also highlighted how the share of employee pay compared to sales increased during the pandemic when sales slowed down, but it has since dropped as sales recovered in FY24. He suggested that this wasn't because companies are suppressing wages, but because they are becoming more efficient. Sinha concluded by saying that weak urban demand likely has deeper causes, such as larger economic challenges beyond just how much employees are being paid. So, how was this episode? Please let me know in the comments below.